Hi everybody, welcome to Chapter 3. Hopefully you've had a chance to go through the PowerPoints, read the chapter, review the PowerPoints, and try the homework for the first time. And hopefully if you have any confusion, this will clarify some issues for you. So first off, I wanted to give you a mnemonic device to help you remember what sort of entry to use for each type of account to increase that particular account. So Alice is how we remember that. So assets are increased with a debit entry. Liabilities are increased with a credit entry. Income or revenue is increased with a credit entry. Capital or owner's equity is increased with a credit entry. And expenses are increased with a debit entry. So remember, Alice reminds us which entry to use to increase each type of account. So if you find yourself getting confused when you're trying to do journal entries, refer back to Alice and hopefully that will clarify for you. Let's move on to a homework problem. As you can see, this is brief exercise 3.3. So first, even though the problem doesn't tell us to do this, let's go ahead and analyze the effects of each transaction on each type of account. So your homework will have you do this in tables. So let's do it like that as well. So let's look at assets, liabilities, owner's equity, revenue, expenses, and net income. So remember our basic accounting equation. Assets equals liability plus owner's equity. Revenue minus expenses equals net income. That will help guide us if we get confused on what sort of reaction each account has to each transaction. So on January 18th, we issued capital stock in exchange for $400,000 cash. So we increased assets. Did we increase liabilities? Decrease liabilities? Nope. They had no effect. So therefore, if we increased assets to balance our equation, we had to have increased our owner's equity. We didn't have any revenues in this transaction. We didn't have any expenses, and therefore there's no effect on our net income. Let's look at January 22nd. Borrowed $100,000 from its bank by issuing a note payable. Did we increase our assets? Yes, we received cash. And how did we do that? We did it by incurring a liability or a note payable. So therefore, since we've increased our assets and liabilities, there's no effect on our owner's equity to balance the equation. Did we have any revenues? No, we did not. Any expenses? No. And therefore no effect on net income. January 23rd, we paid $200 for a radio advertisement aired on January 24th. So what happened to our assets? They decreased, didn't they? Because we paid cash for that radio advertisement. Did we incur any liabilities? No, we didn't. So to balance our equation, owner's equity had to have also decreased, which makes sense if you think about it. We spent cash, and therefore the owners no longer have as much ownership interest in the form of cash in the company. So revenues, did we have any effect? No. However, we did increase our expenses, and therefore if we increased our expenses but didn't increase our revenues, we had to have decreased our net income. Expand our table a little here and look at January 25th. We provided $5,000 of services to clients for cash. So we increased cash, didn't we? Did we do anything to liabilities? No, because we provided the services. So therefore our owner's equity increased. we provided those services, so that is income or revenues, isn't it? So we increased our revenues. We didn't incur any expenses in this transaction, so therefore our net income had to have increased. Let's look at January 26th. Provided $18,000 of services to clients on account. So even though we have not received cash for this income, we're still going to recognize it. We're just going to do it in the form of accounts payable or accounts receivable. Sorry. So we increase our assets. We didn't incur any liabilities, and therefore our owner's equity increased. Revenue or income is going to be increased. We didn't do anything to expenses, and therefore net income increases as well. So let's move to January 31st. Collected $4,200 cash from clients for the services provided on January 26th. Now this one's a little bit tricky, so let's think about it for a minute. What did I do? I had collected cash for what used to be an accounts receivable, didn't I? So all I've done here is swapped assets, essentially. I've swapped accounts receivable for cash. And I've done that in an equal amount, and therefore there's not going to be any effect on my assets. I didn't affect liabilities, and therefore I didn't affect owner's equity. I've already recognized this revenue on January 26th, so I don't recognize it a second time. No expenses were involved, and therefore at this point there's also no effect on our net income. So let's use this same problem and go through some journal entries. Okay, now we're ready for journal entries. So let's look at the problem. January 18th, we issued capital stock in exchange for $400,000 cash. So what I like to do is think about each account that I'm affecting. So on January 18th, I increased cash, didn't I? So if we refer to Alice, I do that with a debit entry. And my cash increase came because I issued capital stock. Capital stock is a part of owner's equity, and therefore is the C in Alice, and gets increased by a credit entry. So there's our first journal entry. So January 22nd, I borrowed $100,000 from its bank by issuing a note payable. So therefore I've increased cash again, haven't I? So I do that with a debit entry, and I did it with a note payable, which is a liability, and I increased that with a credit entry. Let's move to January 23rd. Paid $200 for a radio advertisement aired on January 24th. So I've paid cash for that radio advertisement, and in doing so, I've incurred advertising expense. So Alice tells us to increase an expense is a debit entry. And I used cash, so my cash is decreased accordingly. And to decrease that is a credit entry. So let's move to January 25th. Provided $5,000 of services to clients for cash. So I received cash from those clients. So my cash is going to increase with the debit entry, and I'm going to recognize that revenue in my client service revenue account. And that's income, and therefore gets increased with a credit entry. So let's move to January 26th. provided $18,000 of services to clients on account. So I've increased my assets in the form of accounts receivable because those clients owe me that money now. And therefore I'm going to go ahead and recognize it in my client service revenue. And we do that with a credit entry. So let's move on to our last transaction, which was we collected $4,200 cash from clients for the services provided on January 26th. So don't let this one confuse you. So I've increased my cash because I've received cash for what were previously credit accounts for my clients. So therefore I'm going to increase cash. Now I need to show that that's been collected. So my accounts receivable declines accordingly. And I do that with a credit entry. Now, I don't have any service revenue recognized, do I? Because I've already recognized that revenue on January 26th. So therefore, I have no entry into my client service revenue. So I hope this clarifies for you, and if you have any questions about your homework or any of the chapter concepts, don't hesitate to email me. Talk to you later. Bye.